Great. Well, you've made it to our final lesson. Congratulations. So I've saved the best for last here for those who are still with me. And we're going on to look at a leverage buyout valuation now. And you can see, just like with the DCF, I've set up some extra assumptions that we need to make in order to come up with an estimate of how much we think the business is worth for a private equity investor's perspective. And there's assumptions here in rows 9, 10, 11, and 12 that I just want to draw your attention to. First of all, thinking about what is the required rate of return for that private equity investor. And he wants to generate a 25% compound annual growth in the equity that he invests in this company to make the transaction worthwhile for him. So that's a key assumption. What is his required rate of return? Next assumption is the equity investor is not going to hold this asset or business into perpetuity. He's looking to buy it with a view to selling it at a future point in time. And we're going to assume he's going to sell it in year 5. So he has to have a really good idea of how much he thinks it's going to be worth at the end of year 5. And so we've made an assumption here of 6 times its year 5 EBITDA, which happens to be the same as the multiple that we use for the multiple method in our DCF. So we're being, to some extent, consistent with that estimate of what we think the business is going to be worth at the end of year 5. Another key assumption is how much money can he borrow from the banks? What amount of new debt can he raise in order to facilitate this transaction for him? And we're going to assume he can raise 5 times the current level of EBITDA to help him fund this transaction. And then how much is he going to pay on the new debt that he's raising? They're paying 3% on the current debt in the company. And obviously they're raising a lot more debt, so there's a bit more credit risk. So I'm going to assume a 5% interest rate for the new debts that he's going to use. And then just giving you a brief overview of the journey that we're going to go below. We're going to start by just bringing in the unlevered free cash flows, which is exactly the same as we did with the DCF. We're going to then model the new debt that's being raised and think about how that's going to be serviced in terms of the interest and the principal repayments. Then we're going to think about how much the business is worth in year 5 and how much debt he'll have to repay at year 5 when he sells the business. And therefore, by implication, how much equity he will have after repaying the debt at the end of year 5. So we can estimate what his equity would be worth at the end of year 5. And then we want to calculate what the present value of that equity would be to him today, assuming he has a required minimum return of 25%. So we're going to calculate a year 5 equity discount factor to express the present value of his equity. And that's essentially the maximum amount of equity he'd be willing to put into the transaction to make it worthwhile for him. And then from there, we can work out how much he'd be willing to offer for the business in terms of the total enterprise value, because it's his equity plus the new debt that's being raised to fund the transaction. And then from the shareholders' perspective, we can then work out how much they'd be offered for their shares by making the adjustments for the cash and the debt, just like we did with the DCF valuation. We're then going to do a quick sense check to think about what that is as an implied multiple. And then finally, just to summarize by thinking about what the overall sources and uses of funds within this potential leverage buyout transaction would be. So that's the plan. Let's start by thinking about the unlevered free cash flow again. So with the unlevered free cash flow, we have exactly the same template that we had for the DCF. So I'm going to start off, but then I think I'm just going to pause and just bring in all the numbers just to save a bit of time. So all you'd need to do is just go onto the DCF sheet and just bring these numbers across from row 16 and row 17 and so on. So hopefully you're getting the idea. Just bring in these numbers. You can build the subtotals again if you like, but I don't think it really makes much difference. I'm just going to pause my presentation and just bring in the rest of the numbers just to save a bit of time. So hopefully you can also do the same, and then we can see that we've got all the numbers in just a couple of seconds. So I've just brought in all the numbers from the DCF sheet into column E, and you can see I've got the same unlevered free cash flow, 52.6. And then I can just copy across all those formulas into column 5 just to complete the forecast there. Great. Okay, so the next thing is to think about how much new debt I'm going to be able to raise to help me, or help the private equity investor fund the deal. And our assumption here was 5 times EBITDA. And that's in a conventional way in which the level of debt or the debt capacity is expressed on these transactions. So 5 times, let's apply that to our latest EBITDA number, which is 155. So I'm going to be able to raise 775 to help fund the deal. And then I want to see, well, how is that going to work its way through the 5 years in terms of repaying the debt and servicing the interest? So I've got a little movement here looking at how that debt is going to change through time. So just like I did with PP&E and retained earnings, I've got a beginning balance linking to the ending in the previous year. I'm going to accrue interest, owe interest on my debt. So I've got an interest rate, 5%. I need to fix that because I'm going to be copying it across. Apply that to my beginning balance at the start of each period. And I'm going to pay that interest as well. So I want to also reflect the amount I'm accruing, the amount I'm owing, and the amount I'm paying. I'm going to pay the interest in the period in which it accrues. Now, as I pay the interest, I'm also going to get some tax relief on that interest payment from the taxman. And this is where private equity transactions can be quite attractive from a tax perspective. And the tax relief I'm going to get is effectively cash back from the taxman. It's basically reducing the tax I would ordinarily have paid, which I've got there in row 18, because I've got interest expense being incurred in my business. So the tax relief I'm going to get is based on my tax rate, which I need to go back and find from my input sheet. It was 30% tax rate, and I'm going to apply that to my interest payment. So I'm going to get effectively cash back, or a reduction in my tax charge of 11.6 as a result of that extra interest cost. And then, well, how much cash is then left to be able to repay some of the principal amount of debts that I've borrowed? And the formula I'd need for this would be taking my unlevered free cash flow in row 25, less the paid interest, which I'm already expressing as a negative, and adding the tax relief that I've got on that paid interest. So these are all my cash flows that I need to factor in to work out how much cash I have to make principal repayments. And that's giving me a positive value at the moment, but I really want to express that as a negative value because I want it to be deducted from my beginning balance. So I'm going to put that in brackets with a minus sign in front of it. And therefore, to get to my ending debt balance at the end of the first year, I can just build a sum function and sum up all those values from 27 to 31. So there we have it. I should be able to repay a small portion of the debt in the first year. Well, having done the first year, let's then copy those formulas all the way across to the right and see what our ending debt looks like at the end of year 5. So it's gone down by what, around 100 in total that we've been able to repay. And then at the end of year 5, as we've said before, we want to estimate how much we think the business will be worth, how much we'd be able to sell it for as an enterprise value. So we're assuming 6 times its EBITDA in year 5, and obviously EBITDA has grown. So we think we'd be able to sell it for 1208.1. That's exactly the same as the terminal value that we used in our DCF using the multiple method. Now, take off the debt that we think is remaining at year 5 to get to an estimate of the equity value that we think we would then be able to realize for ourselves as the private equity investor. So 529.7 is what we think my equity would have grown to by year 5. And I want to express it in today's money's terms. So I need to calculate a year 5 discount factor, but not using my weighted average cost of capital, but using my minimum required rate of return for the private equity investor. And that is assumed to be 25%. So 1 divided by 1 plus 25% to the power of 5 gives me that year 5 equity discount factor. So I can apply that to the year 5 equity value to estimate what would be the maximum amount of equity my private equity investor would be willing to invest today. Add to that the new debt he's raising from the banks to fund the deal, and that will get to the maximum enterprise value that would be attached to the business today to make it worthwhile, to still make it worthwhile to do the transaction for the equity investor. Then to reconcile that back to how much the shareholders would receive from that transaction, again, I need to make the same adjustments as I did for the DCF, bring in the existing cash and take off the existing debt. So I'm going to bring in those numbers. I could go to the balance sheet, I could go to the DCF. I'll go to the balance sheet again, just to show you one more time where they're coming from. It's the most recent balance sheet date, which is kind of assuming when the transaction would take place. The cash and the long-term debt are coming off, and sum those down to get to an estimate of how much we'd be willing to offer for the equity. I've got a number of shares outstanding from my DCF sheets. I'm going to bring that assumption through. It was 80 on row 42. So the offer price per share I have as 10.17. And as a multiple of EBITDA, take my numerator from row 41 and divide by the denominator, the EBITDA in the historic period of 155. So you can see I get a result very, very similar to the DCF valuation, and it's not always the case. It really depends on a number of factors, such as the assumptions that I've already highlighted at the top of the DCF and the LBO working sheet. Okay, and just to finish off the LBO sheet and to try and give it some clarity, I just put together this simple sources and uses of funds table just to show you how much new funding would be raised and how it would be deployed. So I'm going to be offering to buy the company from the current shareholders. That's the equity offer value. I'm also going to have to repay the existing net debt. So the net debt I would take as the sum of the debt and the cash, and I'm repaying that. So I want to put a minus in front of it to get to the sum of those two values. That's the total uses of funding, and I'm raising 775 of new debt from various banks, and my private equity investor is willing to invest a maximum of 173.6. So he is going to put in some, or he or she is going to put in some equity to fund the deal. So there we have it. We have an LBO valuation, we have a DCF valuation, we have a 3-statement financial forecast model. I've kept it as simple as I possibly can, just to give you a brief overview of these topics I'd really welcome your comments and feedback on the course, and I hope you found it useful.